Welcome back, Portfolio Builder members. We've got a no trade alert update. We're going to wait one more week. Reason why is we have NVIDIA earnings coming out tonight, which could be really good or really bad for the market. And then we have Jerome Powell on Friday, who's going to potentially move the bond market up or down. If it comes across hawkish, which I'm afraid of, it's good to just wait one more week. But essentially, we're looking at adding to our crypto position. We like a few different options to diversify beyond coin. And if we do think they're going to start easing, then I like to be long NRGU as well. We could also be adding to our bond position, TMF, and then topping up UVXY. But again, I think one more week is going to be smart. We finally got a little bit on bonds today. They've been under a lot of heat, even though inflation's falling globally quickly. So we're just a little surprised. I think it's a supply shock essentially, and not an inflation shock now. And the good news is the supply shock is going to wind down in the coming months. And if the Fed does ease, the two biggest sellers of bonds, which are Japan and China, can slow down because their currencies will start to recover. So that's what we're looking at. High risk portfolios up 47% year to date. S&P 500's 15. Let's go ahead and jump into the allocation. We have tiny position in UVXY with 4 shares. Then we have 98 shares of TMF. So that's coming in at 13% of the portfolio. That's betting on interest rates falling. Definitely would like to add to that next week if we get the right commentary from Jerome Powell. Then we are long the dollar with EUO. That's been just a safe position for us to basically be ready to make the move if Jerome Powell comes out super hawkish and the inflation starts to run up. EUO is a really good spot for us alongside UVXY because it means Treasury is going to get hit again. So just waiting another week on that before we make any changes. We're still long Coinbase with Coin. 17 shares, that's our second largest position, coming in at 28% of the portfolio. And we've got our inflation hedge in place. And again, I'd like to add to that eventually in RGU, the big oil companies times 3. So this is up 47% year to date with 5% drawdown in August. And we're just really sitting back waiting for enough data to come in to make a big move. And basically, we're really just waiting for interest rates to fall because we have predicted what would happen with inflation. The Safe Growth portfolio has had a large bet on treasuries, which obviously have been hit. We'd like to essentially hold that till it goes up significantly, probably 2, 3, 4 times. And if anything, we may take some risk off the offense and move it to the defensive side once we're ready. But I really like all the offensive plays in this portfolio. They're all value plays. Emerging markets will do extremely well if inflation is falling and the dollar is falling and the Asian currency is going up. So we have 12 shares there. We have 22 shares of GBTC. This has been our best performer. A little bit of a pullback, obviously, recently. Don't see us changing that position. And then we've got the oil play. So really not a lot of changes, most likely coming to Safe Growth. I think we can pretty much sit back. All of these plays will do well outside of the oil play. In terms of actually all of these plays will do very well if we end up getting the DXY index to fall, which again is only going to happen if Powell starts to signal he's going to ease, which would allow basically Japan and China to stop selling treasuries, stop having to defend their currencies, and this portfolio should really fly and catch up. It's down 4%. I do think without any changes, except for perhaps adding a little to UVXY, this portfolio can do extremely well in the next 12 months. Okay, so let's look at the latest data that we want to focus on. M2 has been a relatively good indicator of where inflation's heading. And it's currently saying that inflation is going to fall well into 2024. Okay, so far that's been working out well. Some of the risks to this would be if energy starts running up too much. And that's why we have the energy hedge to protect against that. Otherwise, pretty much everything's falling significantly globally. Here's the German CPI and PPI. Their manufacturing sector is now in a recession under 50. Their PPI has gone negative and their CPI is starting to fall. So we'll see if that trend continues. We expect it will. Here's all of Europe, same pattern. We've got some labor inflation in the UK that's been a little bit worrisome, but outside of that, looks like inflation is set to fall rapidly in Europe. If we compare the Chinese producer price index to the US CPI, we can see Chinese PPI has gone negative. Their imports and exports have slowed down dramatically. This is pointing to a fast falling CPI as well. So perhaps the real risk is not that the inflation is going to return, but the Fed doesn't ease soon enough and pushes inflation too far down to the point that they would crash things. If they're going to crash things to the deflationary side, TMF and UVXY are where we're going to make a lot of money, and likely stocks and oil companies are going to get really smashed. So it's going to be very important to watch what happens with Powell on Friday. Then we have the non-farm payrolls first week of September. On the 13th, we have the CPI, and then we get the next rate decision in September, which again is so far pricing in a pause, but that now there's a risk of a rate hike in November. Here's a look at the Bitcoin. So we got a lot of big things coming for Bitcoin and crypto. We have essentially the Bitcoin halving coming up. That's one. And then we have, which is really, that's where these blue lines are. Typically is when you start to get a melt up is around the halving and sometimes leading into it. And then also we have the BlackRock ETF coming. And funny enough, they're probably going to be launched right after the halving. So they could be launching their Bitcoin ETF early next year into a melt up. Also, for whatever reason, perhaps politically motivated, most of the big melt ups for cryptocurrencies have coincided with election years. And you can see these melt ups that have occurred alongside that. Here's another chart looking at volatility getting low. Of course, we just got some more volatility last week, but typically when volatility gets really low, it's led to some melt ups. And now we also have a record of Bitcoin supply being held by long-term holders at 75%, which is similar to what we hit in 2015 when China was bailed out, which could be happening very soon, and led into, again, that 2016, 17, 18 melt up before yet another crash. There's an unknown entity that's accumulated $3 billion worth of Bitcoin. Maybe it's Gemini, maybe it's BlackRock. And so again, we're very bullish on cryptocurrencies, despite all the regulations and attacks on the industry. The macro fundamentals are setting up very, very nicely. And we got the biggest financial institutions in the world all jumping in on this at once. So another reason we believe inflation is going to slow down is the excess savings is going to run dry here very, very soon. We've ran out of $2.1 trillion worth of excess savings, down to 1.9. They're running at about 100 billion a month. So in 2 months, that should be all ran out. Good news though is people have got big raises. A ton of people are essentially in a job, and everybody's stock accounts are up this year. So we don't think the economy is going to die. We think that essentially going to have a strong economy with falling inflation, falling interest rates. So it should be very good for stocks. Meanwhile, the U.S. deficit is at spending this year is at 5.7 trillion, and will go above 6 trillion by the end of the year, which again is very good for the economy. So this is what's caused the bond glut. But the good news is the spending needs are going to slow down in the very near future. It's one of the worst returns for bonds in the last 300 years. So most likely we're going to have a very good period of time for bonds very, very soon. As interest rates go down, it makes the relative value of stocks go up. So you can see the US spending is staying on trend to keep the stock market up so that tax receipts remain high and labor markets remain full. So this is the big disconnect in the market, NASDAQ versus treasuries. Our belief is that most likely treasuries are going to moonshot up towards the NASDAQ soon as Janet Yellen is done issuing so much debt, and soon as Japan and China are done dumping treasuries, trying to protect their currencies. There's also a massive short squeeze that can develop on treasuries in the very short term. Here's the long-term trend for bonds. which again, since the 80s has been in a downward spiral, we think this will probably break to a new low within the next 5 to 10 years. And it's the only way these governments can keep running these massive deficits. Now, if you look at this, you can see how much money we're raising in September, and then in December it drops. Next year it'll continue to drop because now Janet Yellen's sitting on a ton of cash and won't have to issue so much debt. So we're really close to potentially a big short squeeze in treasuries. Now, the Fed pause 3 out of the last 4 times has led to massive stock market rallies, and this could be happening right ahead of the election. So a lot of things are lining up. The only exception was in the dot-com bust, where we had a double whammy of inflation. You got the run up, and then it re-crashed, and the government went from running a deficit to a surplus, which created a 2-year bear market. And they never tried to do that again. So as long as we don't get a politician in power that wants to balance the budget or create a surplus, which is obviously not very likely, we're really positioned well. Here's that short position in yellow on the 10-year treasury. Again, the second that gets short squeezed, you're going to see a massive bid on bonds, and it's going to be very bullish for the market, so long as it's not due to banks collapsing or something of that nature, which is still a risk that we're following, is whether any of these banks are going to be insolvent because of bad bonds on their book, on their balance sheets. 2-year has flatlined, signaling perhaps the top of interest rates is in from the federal funds rate. Treasuries, which start off the year well, have declined 33% on TMF. Again, we like this position. I think we're very near the bottom of the bond route. Dollar index is set to fall after running up to 103.5 again. And again, this won't happen until the Fed signals a pause so that Japan and China can stop dumping treasuries. And again, we believe the DXY index is going to fall soon as we get inflation tamed enough for the Fed to pause, which could be probably by November. I think we will pause September, but there'll be an open question as to whether or not they do a rate hike in November. It'll be data dependent all the way up to that point. And as long as we have labor markets cooling off and inflation continuing to fall and energy not skyrocketing up, we should be in a good place for the dollar and interest rates to fall together. FNGU is up 316% for the year, extremely high valued. It's all running on NVIDIA earnings. If we somehow get a really bad beat and create some sort of significant sell-off, I'd consider getting us back into FNGU. We made a lot of money on that this year, but now the tech stocks are priced to perfection on this whole AI hype. So let's just be patient to look at that. I'd rather get into crypto because the second all this AI hype disappears, there's a huge catch-up trade between crypto and the NASDAQ. Typically, Ethereum will outperform the QQQ 3-1, and this year it's really just tied. So the second all the hype and money flows are not as excited about AI, we're going to likely see that big catch-up trade occur. Here's Coinbase, which has had a pullback but starting to rebound here. That's one play we like. I like GBTC, ETHE, Coin, and Mara as some options for crypto exposure. Of course, Rebel Dividends is a leverage play that's extremely diversified and your better bet for crypto if you'd rather have our company manage that for you. GBTC up 102% for the year. EDC, again, started off the year really well, like bonds. We had the bond crash, took China right back down. China's going to likely start stimulating aggressively as soon as they get control of their currency, which again, they're reliant on the US to signal easing from the Fed. So this play we really like. Here's oil, Brent oil. You can see it's had a pretty big run up from 2020 to 2022, crashed back down, and then it started running back up this last month. But over the course of 1 year, again, we can see it's pretty much trading flat with NRGO. The 30-year is way over trend. Again, we're expecting this to top out and crash lower, which is why we're long TMF. The gold play has been kind of stalling out here lately. No real signal from that yet. And again, we're more interested in crypto than gold or silver, but we are looking at trends in that. Here's UVXY. Again, they've just crushed volatility for the last year. And we believe unless inflation starts to run hot again, that likely this is not a position we want to get too big on yet. Now, if inflation is running hot, energy is running up quickly, I'd like to load the boat on UVXY and expect a big sell-off. The regional banking crisis had been recovering, but has been selling off a little bit lately. A lot of people are worried that some of the big banks could still be in trouble if interest rates don't fall soon. Here's your S&P 500 up 14% for the year. Had a little bit of a pullback and starting to get back in a bullish trend. And again, assuming that NVIDIA's earnings don't tank the market tonight, and that Jerome Powell doesn't come out scaring the markets of more rate hikes, we could be getting ready to push towards new highs here in the coming weeks and months. NASDAQ's up 37% for the year, same trend. Again, bigger risk in the NASDAQ via NVIDIA's earnings today. Russell 2000 would be a catch-up trade. We're not in this play, but again, it's been basically just the big AI tech stocks that have led the market higher. So again, we'll see how that plays out. U.S. consumer spending continues to grow, but it's slowing down. Balance of trade is slowing down. All signs of less inflation. We can see retail sales continue to be strong, but again, slowing down from those 1 to 2% gains. Consumer credit continues to grow. No collapse in credit. But we did see basically a flat line in bank credit, and that was due to the regional banking crisis. But it looks like this is relatively recovering. And again, if interest rates start to fall rapidly, these balance sheets on banks are going to improve dramatically. China's PMI has been falling for 3 months, which freaked out everybody, but again, still in positive territory. Their imports have gone significantly lower, about $20 to $30 billion lower from when we're having heavier inflation. But again, not in a level that would freak us out. And then Chinese exports remaining pretty flat, but falling about 10 to 15% over the last year. Okay, so that's what we're looking at markets. Again, we're going to wait 1 more week and likely pull a trigger on Wednesday, depending on what Powell says and depending on what NVIDIA's earnings are tomorrow. So I know it's been a while we sit there, but John says, do I like TNF? No, just TMF is all we want for bonds. Don't look at anything else. It's by far the best product because it's the 20-year bond leverage times 3. So the longer duration, the more money you make if interest rates fall. So you want that 20 or 30 year, you don't want the 10. And then again, we want that 3 times leverage. So we can make a ton of money once bond yields finally fall. And it's been all year we've been waiting for that to happen. So again, right now, I don't think it's from inflation. I think it's from supply, and then from weak currencies in China and Europe, China and Japan. Gary says, what's your read on BRICS? Yeah, I think that's more like a 10 to 50 year play where the dollar slowly maybe loses power. But in general, China seems to be in a very bad spot in terms of trying to become some sort of dominative country. And that's due to a lack of children coming through. So they're going to have a massive demographic problem. Europe, they just fight with each other constantly. So I don't see the euro overtaking us anytime soon. And now US tech is just dominating once again. Our military still dominates. So yeah, I'm not worried about the dollar losing reserve currency within probably 20 to 50 years. Okay, very good. So again, if you're not in Rebel Dividends, highly recommend you give Dean a call. Now's the time to pile into this. We've gone through every shitstorm you could possibly imagine. We've really optimized our strategy. We're positioned to make a massive amount of profit in a bull market for crypto compared to anything you can get in your stock trading account. But yeah, that's what we have for you today, guys. We'll be back next week with a trade alert, most likely. And if you have any other questions, email us at support. Otherwise, thanks for joining us live, and we'll see